folks, and welcome to the Contrarian Trader. This is Robert Desmond. It is Sunday, December the 14th, 2008. Folks, before we get into this week's commentary, let's first recap last week's commentary. Last week I mentioned that I was bullish on the stock market on a short-term basis, and that bullishness was formed by and large out of the bad news that we were hit with the prior week, and yet we were able to rally off of those numbers and close higher the previous week, which is great news. Similar price action this week as well. This past week we had earnings forecasts come out downward revisions on some major names. 3M, a major manufacturer, Texas Instruments, Tech, Kroger, major retailer, a food no less, defensive name, Nucor, a steel name, a commodities name. They all lowered forecasts. Jobless claims were released this past Friday. 573,000 new jobs were lost. New jobless claims were filed. I apologize. That's a 26-year high, and yet the market was able to rally on this absolutely horrible news. So what that tells us is that a lot of this bad news is already priced into the market, which is a good thing. So that sets the foundation for us to rally. Now, what I always like to do is I always like to start off with the big picture view, and this is the monthly chart of the S&P 500. And as you can see, I drew this trend line a few weeks ago, and this marks the trend line from the upper trend line from the 2003 lows. And as you can see, coincides with the 850 level, and we breached that support level this past week, yet we were able to rally back and close above the 850 level. So we're going to want to keep an eye on that 850 level, okay? If we close below on a weekly basis the 850 level, start to take some money off the table because we're probably breaking down. So keep an eye on it. Now let's get to the daily chart, because what we believe this to be a short-term trading opportunity here could last for up to a few weeks to a couple of months. But on a long-term basis, we're still bearish in this market. So let's take a look. And as you can see, we have an ascending triangle forming here. And we broke below this rising trend line here, yet we were able to recapture it, bounced off that 850 level. There it is again, that 850 level, critical that we hold it. And now our next challenge is going to be the 900 level. We tried it the last week, failed. We tried it again last week, failed. We're going to need to see some volume here. This is what's causing it. There's no volume. We're going to need to see some volume, push this market higher. Now, what are our catalysts that could push us higher? Well, the catalysts that could push us higher next week are going to be bearish for the dollar. So that could cause the commodity names to rally. Well, not could. It will cause the commodity names to rally, which could cause some volume here and bring us to newer highs. So let's keep an eye on the 900 level. That is our resistance level. Our support level right now is the 850 level. So let's refer back to that next week as I do my recap of this week's this coming week's trade. Let's take a look at the financials last week. Again, as I said last week, the proximate cause of this bear market are the financials. Now this is the chart of the XLF. And on Friday, as you can see, great action here. Okay, we were reversed, closed higher out on bad news. Great price action. All right, the only thing that's missing, I'd love to say great price and volume action, but I can't. Again, I have to take a look at the volume. Always take a look at the volume, and there was none. There was no volume on Friday on the XLF. There was no volume on the S&P 500. So that concerns me greatly. Where we did see volume, and again, this is one of my proxies for the market, where we did see volume was on the Russell 2000. This is the IWM, the Russell 2000 index. Remember, as I always say, these are the most innovative stocks, the most innovative companies. And if they do well, you can expect the entire market to do well, because they're your smaller companies, your mid-sized companies, and if they're not having a problem accessing credit, then that's a good thing. And as you could see last week, some beautiful action in this sector. The volume came in on average, okay, but as compared to the S&P 500 and the financials, it did comparatively much better than both of those other two indexes and sectors did. So Look, the price volume on Friday on the IWM was bullish, somewhat as compared to the other two. So let's take a look at these small caps. I like the small caps right now. Got me very interested in those. Um, I mentioned the dollar and some events that could affect the dollar next week. Are the Fed will be meeting next week, so keep an eye on them. They might just cut the rates to the bone, right next to zero. If that happens, you can expect continued weakness in the dollar. Last week I mentioned we were forming a head and shoulders top. Here's your head, left shoulder, right shoulder, and I predicted that we were going to break down and we were going to see the dollar break below its 50-day moving average. It did so. Here we are. Found resistance at, say, 83.50 level. So that's where we'll go into the week next week. We may see a little bit of an oversold rally in the dollar going on Monday, but as the Fed meets and more talk of this bailout of the auto industry gets spoken about, you're going to see weakness in the dollar. We're taking on huge amounts of debt. And what they're talking about, this $14 billion, is only a down payment to keep the auto industry going until the Obama administration comes in, and it's going to cost another $100 billion in debt. Believe me, this is not cash that we're spending here. These are the printing presses printing IOUs out. They're hoping that the Chinese are going to buy our treasuries and keep this company, to keep this market aloft in the sector, or this economy aloft. And the fact that we're dependent upon the communist Chinese is something so concerning to me. It'd take me another video to express my true feeling about it. Let's take a look at the VIX. I mentioned last week that it was rolling over. Sure enough, we saw a lot of weakness. And this is a very bearish candlestick chart pattern on Friday. So I like that tail. That means more than likely we're going to see further declines in the VIX. Look for a break below the 50-50 level. You see a break below that 50-50 level, you're going to see a rally in the market. If we break below 44.25, that means the VIX is broken, and it'll trade down to its 200-day moving average, which is at 33.33. So look for a breakdown in the VIX. If we break below this 44.25 level, you're going to see a massive rally in this market. So keep an eye on it, please. Last week we went long. Oh, just to recap. I mentioned last week that if we saw a breakdown in the U.S. dollar, you'd see a rally in U.S. steel and you see a rally in oil. I'm still bullish on these two. I'm still bullish on commodities. Let's put it that way. I'm bullish on commodities because of the weakness in the dollar. Let's not just pick out a couple of names out of the hat. But the two I referenced last week, the USO, which is crude oil, had a beautiful week. Look at this, beautiful inside week. Look at the volume here, incredible volume. That's what we want to see. Okay, oil's bottomed here. It's done. You may see a slight pullback, a retest of the lows. What you're seeing here, 33.08, is going to be very, very difficult to break below. With this type of volume, that's telling us that there are buyers out there ready to buy. OPEC's cutting production. Whether they stick by them, that's another story. But for right now, bullish on oil. Last week again, I mentioned dollar breaks down, get long steel. What happened? Okay, look at the spike. We had a 10-point rally in steel last week. Congratulations to those who joined in on that rally. Right? Great trade. UNG, we added natural gas to our portfolio. We started building a position. We're not fully long in natural gas yet. We could still see a little bit of a pullback, right? But I'm bullish on natural gas, using the UNG as our trading vehicle. Last week we also, I brought up the airlines in the middle of the week to my subscribers that I was bullish on the airline sector. I've been watching for a while. I wanted to see a pullback to see whether or not it could hold, especially in the face of oil rising. They closed up on the day on Friday because of the pullback in oil. If there's one thing that concerns me is a rally in oil is obviously may undermine the rally in the airlines. But one stock in particular I do like is United Airlines. If we see a convergence of the 50-day moving average cross above this 200-day moving average, what we could be setting up for is a secular bull move in the airline index. And this is going to be a longer-term trade, possibly up to a year and a half. And because these companies, they've streamlined considerably. They've gotten ready for this recession. They're now going to take advantage of these lower energy prices as well. So they're lean and mean as opposed to a lot of other industries right there, and they're predicting their profitability in '09. Not many companies could say that. So the airlines are predicting profitability. UAUA, which is United Airlines, is going to be our vehicle. Delta is another great stock to get into. DAL. So folks, keep an eye on them. I'll probably reach out to my subscribers again during the week to give them an update. And please subscribe to my channel. Stay tuned for next week's week ahead commentary. And if you'd like to join the club, please visit www.thecontrariantrader.com. Have a great week. And watch the volume, please, folks, okay? Watch the volume.